This video is all about how to predict a recession with 100% accuracy, looking at indicators, and then also how we can profit from those situations using those indicators and technicals as well.
Just kick it off and tell us what indicators you've been looking at that predict a recession.
Yeah, well, there's definitely a big one, which is the yield curve. It takes a 10-year treasury bond yield return minus a government issued 2 to 3 year treasury bond. It's basically had a 100% track record of predicting recessions even since the 1930s, 1929. You look at the 60s, 70s, 80s. Every time we've had basically a steepening decline and then an inversion of the yield curve, we've then held this zone for a long period of time, and then as we've increased at a rapid rate and got back into positive territory and uninverted, we've then seen a recession every single time. When we've had other sort of declines, like in 2022, we weren't at those levels, but when there's been a proper recession, not just a downturn, this has triggered every single time, which is...
And do you know what the timescale has been between the inversion reversing and the recession starting? Of course, recessions can start long before they're actually announced by powers that be. It's 2 quarters of negative data, but you could potentially be in a recession before we were told about it.
We've uninverted this yield curve and we've entered into positive territory. It's not been as steep an entry into positive territory as it has done previously, because it's tracked sort of sideways in December, but all the recessions, say from 2000, so the dot-com bubble, 2008 to basically now, we've had the level of the uninversion go to, it's between 0.1 and 1%, and this is basically like a hot zone. As we've been in this territory, all these recessions have occurred, and we're currently sitting at 0.33. The declines will probably start, and you're right though, this isn't like, oh, today's the recession day. It's kind of like, this is, we know we are very close to this time period based on this data, and if we're wrong, then maybe it's time to throw out the yield curve. But it's not been wrong before. But in terms of a time zone, I'd say within a few months, and there's been a lot of evidence of smart money equity leaving. And if you just got to look at Warren Buffett, I think it's the largest cash position he's ever held since, let's say,
something like 350 billion in cash or something like that.
325 billion.
Okay,
his highest cash position in more than like 40 years, 400% higher than it was.
That's a prime indication of what happens at market peaks.
Yeah,
the smart money gets out and the retail investors rush in. So the retail investors are always the ones that buy at the top. They generally buy at the top and they sell at the lows just as the smart money is coming back in again. It's always how it works. So the fact that Buffett and others are doing that, their cash positions are high, that would suggest a top.
The 3-month bond yield percentage is basically set by the Fed and the government, and the 1 and the 2 year as well. You can do a 10-year minus a 1, 2, or 3, and it gives you a sort of similar picture anyway. But these are all set by the Fed, and this is perfectly in line with our anti-government videos, because the 10-year is set by private individuals and just the ordinary average Jones, and seen as basically the ideal interest rate for the economy, and known as the neutral rate. Fed doing all their bits and babs with interest rates and stuff. You still have to watch that, but it's funny that they even governments and smart money have to respect the true rates on these things.
There's certainly a thought process that the central banks can't manipulate interest rates as easily as people believe that they can.
Yeah.
Because as you correctly say, the 10-year is more indicative of the market rate, which is, and it's been pushing up. It's up 4.65% thereabouts now. I think once that gets over 5%, then we're going to see some real problems.
You have to be on top of these things, but it's not hard to keep on top of these things. I'm going to include a link to track the yield curve, the 10-year minus the 2-year in the description. You can see the inversions, you can see the grey highlighted areas where recessions have occurred. And then another indicator I wanted to touch on, which is kind of normally goes in line with the yield curve, but it can lag behind, and in this instance it is lagging behind. This is the jobless claims. I mean, we all heard about it during COVID. Unemployment and jobless claims go up. That's obviously terrible news for the economy as well. You combine that with the yield curve, and they work in tandem. If they can work together, and you can see a rise in both, and that's big indicators of a crash. In this instance, it's sort of not started increasing yet. It's been tracking sideways, but you don't need to have pandemic levels of unemployment for this to be a good double down indicator and double confirmation of what's already being shown. If it starts to increase, that will just trigger a bit more,
It's a
fear.
strong indicator,
Yeah.
but is it not also the case that with the jobs figures in particular, there's been a case of people losing high quality jobs and then taking
Mm,
sort of much lower quality jobs like working in fast food restaurants or working in the lower paid service sector, and
exactly.
perhaps doing
That's
2 or 3
very, very
jobs
good point.
in these sectors, to keep the wool from the door, as it were, after they've lost a much better high paying job, and that again is something that seems to be happening. If you look at these big tech companies, for example, Twitter was a perfect example. When Musk bought Twitter, he was able to fire, what was it, 85% of the workforce,
Joke.
and it still works just fine. So all these other tech companies are obviously looking at that and saying, well,
Yeah.
if we can do this, there's a lot of jobs that are not needed. I mean, you only have to look at some of the videos that some kids are posting on things like TikTok, and about how comfortable the day is working at some of these big tech companies and going in and having breakfast and going and playing pool, and not what I'd call work.
The good thing about the yield curve is, I guess this data is taking something that is not done by the government and then having a comparison against the government figure, so the 10-year against the 1, 2, or 3-year. And what this also highlights is how, what can we actually trust? It's the stuff that's not government driven, because the initial jobless claims is government driven, and we were saying that this might not be totally accurate because of what the quality of the jobs are. The fact that the Biden administration during 2022 weren't transparent about inflation numbers, or they were using a different basket from the typical basket that gives you inflation numbers, which is just
I think I have no love for the Biden administration, but I think every single government in the world fiddles the inflation figures. They all sorts of things in the basket of goods that are not the things that you're buying day to day. They've got lots of things in the basket of goods that don't really matter. But if for example, they have electronic goods in the basket of things which are falling in price generally, like TVs and what have you, you don't have to buy a TV every month. You got to buy food every month. You got to pay your rent or mortgage every month, and these things are going up hugely. So if you just actually had necessities in the inflation basket that's used to calculate the inflation figures would be considerably higher than they have been as they are now, because everybody who has to pay bills every month knows that the utility prices are going up, food prices are going up, and particularly if you live in a country like the UK, where utility prices are, I think, the highest in the world. Our friends in America don't have such great problems, but everybody is experiencing these high prices. The inflation figures of any government can't be trusted, particularly these left-wing governments. Well, I would suggest that your average person is probably feeling like they're in a recession right now, because they're seeing their incomes aren't rising, everything's getting more expensive, the bills are higher no matter what it's for, and this is something that is true certainly throughout the Western world at the moment. So maybe we're already in a recession. Maybe exactly. the way that it certainly feels, it doesn't feel like there's a high amount of confidence out there at the moment.
Yeah, and that touches on what we were saying before we started recording. Is everyone feels like the cost of living is terrible, but for some reason the stock market's all-time high. It's biggest rise in the last 2 years since the 2022 sort of correction, and it's like, why are we here? It doesn't really make any sense, but the market is where it is, but people feel bad.
The other indicator that I saw recently, that you may be about to mention this, but was credit card debt is at an all-time high. US credit card debt is at an all-time high. So it means that people are not earning enough money from their jobs, and they're putting things on the credit card, which again is a catastrophic. But if there's no option, if you need to do that to put food on the table, then you have to do it. But it's not a good sign. It's not saying that the economy is strong.
No, it's not at all. But it's funny because I think we'll probably end up doing another video on helping people how to get US credit cards, because of the point system and stuff. But obviously only if you're in a position to pay off at the end of the month and no interest. But
and the fact that there's so much debt in the world, that increases costs of all these companies that have got debt, and particularly governments that have got debt, exponentially. I mean, we've touched on videos in the past. The US government has got, I think, 36 trillion in debt, which is just a number that's unimaginable to anyone. But that interest rate's at 5%. The interest payment on that is going to be pushing for 2 trillion per year, which is a substantial percentage of the US government's budget. And it's going to continue to increase. It's not sustainable. It has to collapse. I mean, I know we've got the Department of Government Efficiency that's going to potentially save 2 trillion a year, as I've said in the past. I will believe that when I see it. I hope they do it. But
it's too big a problem to solve, as we said before.
and also the fact that retail punters are massively bullish, particularly, you touched on all these influencers making videos, and particularly the younger generation that maybe haven't seen big market declines in the past and haven't experienced that. They think that the markets can only go up, and that's clearly not the case. So it will be interesting to see how this one plays out, but it certainly that is another strong indicator, the fact that the smart money is already starting to get out just as the retail investors are at their most bullish.
And it makes you scared that with these indicators showing what they show, it makes you concerned that, okay, is this the big one? Is this a 1929? Can we recover in a short space of time with a V-shaped recovery?
Yeah.
I mean, people talked about a double dip recession. It never happened. Maybe we hit pandemic lows. That could be crazy. I mean, I'm not saying that's what's going to happen. I don't want to be.
What you have to remember is that everything that's happened in the last 15 years, or since the 16 years since the 2008 recession, it's all been based on low interest rates. Everything. So all the deals that get done are done on borrowed money. Everything that happens. So people are basically playing the yield curve. Even when people are doing private equity deals, they're playing the yield curve. They're borrowing money. They were borrowing money at 2 or 3%, and they're buying companies that are making profits of maybe 6 or 7%. You buy utility or whatever, a company with guaranteed earnings, guaranteed revenues, and you're making that bit in the middle of the yield curve, 3%. If you do that on a big scale, you're making a lot of money. But with interest rates over 5%, that all stops. It can't continue. So all these deals have to be unwound. There's going to be a lot of bad debt, and it's going to be a complete catastrophe with interest rates over 5%. And that's not even talking about all these pension funds, for example, have invested ordinary people's money. They don't know, they don't understand how these pension funds work, and all these funds have borrowed huge amounts of money as well. They've participated in a lot of deals which will likely go wrong if interest rates go above 5%. Or it's happening on a small scale now, but when interest rates inevitably go above 5% and probably much higher, the level of catastrophe that is going to happen in the financial markets is, I think, unprecedented, and will be of a magnitude bigger than 1929.
How we are experiencing the cost of living crisis across the US, the West, and the UK at the moment. It's incredible, and like you say, this is pulling the wool over the eyes of what are the jobs that people do have. If there's a cost of living crisis, people are going to be taking jobs that they don't particularly want, that are not happy with, that they just because it's a job doesn't mean it's something that's covering everything that they need. So the trigger of a recession or something like this could have catastrophic impacts on those people who have then just decided to take the lower paid jobs because the data's not entirely giving the full picture. And I think that's the case with the initial jobless claims. So when we start to see that increase, is going to be even more of a concern. And yes, everything we're talking about in the US is going to affect the UK. I mean, it's funny because the FTSE it barely goes up, but when there's a US crash, it follows the crash immediately, and that's the same with a lot of economies. But linking directly to that, this is another indicator in a weird way that probably no one talks about, is January. The battle between administration, we've obviously, October is typically when a lot of crashes happen, but January, when administrations change, we talk about the Biden administration not using the correct basket and maybe not truthfully telling the inflation numbers because, a lot of it might have been, COVID lag and things like that. But with the Trump administration coming in, or just any administration coming in and a change, they're going to be looking at ways to, if they can see something coming, they're going to be looking at ways to blame the previous administration. And I think on this occasion, it's going to be highlighting this data. Well, it might be that they highlight some of this data because they don't want to be totally to blame for when something bad does happen.
Oh, I think they'll be hoping that if anything bad's going to happen, it happens pretty quickly, then they can blame the previous administration. But yeah. I'm sure from the Trump administration's perspective, they're going to try and keep this bubble inflated for as long as they can. They're going to be putting the central bank under pressure to do whatever needs to be done. Whether it's possible or not is another matter. And you also get Trump coming up with some economic policies, which I would say make no sense. Like he wants to put tariffs on a lot of things. That's such a bad idea on so many levels. The only way it works is there was some talk at one stage where he was going to abolish income tax and use tariffs, which I like that idea, but I suspect that will never happen. And you get tariffs plus income tax, but tariffs are all tariffs are going to do is put the price up. It's a tax on Americans. Trump comes up with this nonsense that it's a tax on foreigners. No, it's not. It's a tax on Americans. And tariffs were one of the big reasons for the depression in the early 1930s. Tariffs were one of the major causes of it. So, I think this is an incredibly bad idea, which it makes no sense. We can only hope that he doesn't follow through with it on a large scale.
Yeah. Whilst I'm making the video today, and it could be any second, any day now. It's good to track these things, wait for the yield curve to have a steep rise. We're in the hot zone though, so you might even want to, and this is going to we can directly talk about now how do we play this. It will be watching these sites that give the data, Fred economic data, and then also the actual technical side of it, looking at indicators on the charts. I've used it before, this 9-period moving average on a daily time frame can show you where, if a crash happens, when to re-enter, or certainly if it's happening and retraces up to this 9-period moving average. I'll be putting images on screen now for people to see. That's when you could maybe take your initial position and have and know where to put your stop. You don't want to be selling when clearly we're in a trend. But I think the S&P 500 now has signaled a kind of a lower high. So you're looking for lower highs, and you're looking for basically a significant drop and then a slight dead cat bounce that you can get into, where you get this 9-period moving average, and then looking at where the price could go to, like the 200-period moving average on a daily or weekly time frame, which is quite far away, but daily is not too far away.
Yeah, you got to look at the support and resistance.
Yeah.
Measurements that you're looking at on the way up, they're going to work in reverse on the way down.
And then looking at the VIX using the same indicators, which I don't think many people talk about. I think we're probably the only channel on YouTube that talk about certainly the 9 combined with the 200. The VIX is hovering and it has been tracking along its 200 moving average for the longest period of time. And we had a flash burst, but not much of a decline. And we've been having these sort of flash bursts up and down from August of 24 all the way up until now. And we've been tracking along this 200. And I think the exact same thing happened. Yeah, and in 2008, the VIX tracked above the 200, but didn't burst up incredibly high, but it just tracked above it for literally a year, and then had so it was going from 15 to 37, which is quite a big rise. You could profit from those sort of swing trades, but then eventually it went from 15 to 95. I think that's the highest reading ever. So since it's existed anyway. 1929 probably was higher, but I don't think there was data back then for the VIX. So it started in 1990.
But the VIX can be an interesting way to hedge your portfolio if you want to stay in the market, but you can buy.
Yeah.
You can go long the VIX effectively to hedge your long positions in the market. It's an interesting indicator to watch, and it can often start to creep up before any market decline.
So there's 2 ways to play it there. Watching those two, tracking the pages that show this data that we've talked about, these indicators, and then using the technicals on the main market and the VIX to buy the VIX, or maybe be buying puts on the main market. And I'd say the S&P 500 is probably a better place to buy puts, because the Dow has still not properly recovered from its drop in December. So
you want to buy very long-term puts if you're going to buy that, because it's obviously a risky trade. You're losing time value buying as well. So and trying to call the top to a day is impossible to do. But but you can get very long-term. But of course, the smartest way to play it, play it the Warren Buffett way, get cashed up now and wait for the opportunities at the bottom.
Cashed up and then put into real money, as we've touched on this channel before, like gold and silver and other things.
Yeah, and then you've got that reserve to buy things when they're super cheap. Imagine if you could buy the stocks you want to buy at a 75% discount. That's exactly what Buffett's going to do.
Yeah, exactly. And then your actual cash pile has increased because you've had other safe haven assets. And I guess what we're saying also in this risk off period, it might just do it for January, because
sometimes heading into the end of the quarter as well, which I think the dot-com crash back in 2000 was in March.
Please don't forget to like, subscribe, turn on post notifications, and join our Discord chat room linked in the description so you can see these plays and get in these opportunities when we do.
In the modern world, great leaders resolve their conflicts